First of all, I would like to invite our panel speakers to come on stage to share with us their thoughts about this breakout session is about achieving and financing the next stage of Asia's development. In no particular order, just perhaps in the alphabetical order of the surnames, we have Sally Chen from the IMF, please. Sally is the IMF person in Hong Kong. Yeah, please. Our next speaker is Fred Hu. Fred Hu, I've known him for many years. Basically he has transformed into basically an investment banker and investor, a Wang Hong, KOL in China. Our third speaker is Julia. Julia is from the SFC. Again, I've known Julia for many years. Actually, this morning we were talking about the future of work and the need to, keep updating yourself and transforming yourself. Julia is a live example. I'm not so sure how much you know about Julia. She was, if I'm not mistaken, I haven't actually read any of your bios. I just, regather my impressions of the past. Julia started with, I don't know what she started with, but she was with the Asian Wall Street Journal for some time as a journalist, and then she was with the Hong Kong Monetary Authority, initially in in PR or public relations. But gradually she became in research, monetary systems, currency issues, and now she is a regulator in the securities and futures. And finally, we have Lawrence Lee. Lawrence, again, is a man of many talents. He is a barrister by background, but he is now, of many of the things he does, he is now our chairman of the Financial Services Development Council in Hong Kong. We have heard a lot this morning, a lot of interesting ideas for thought, but a few issues that have been highlighted, I think, are very relevant to our discussions this afternoon. Mike, many thanks for all your insights. This morning talk about the invisible revolution and all these all the changes we are seeing now. I mean, all the rapid developments and the need to think about a new model, a new way of dealing with the new world. I'm not going to repeat all what he said this morning, but based on what he said, what I felt this morning was fintech is a big part of this invisible revolution. We will have a few people talking about fintech later on. And then, of course, the other issue is about equitable development. Rob Johnson this morning talked about social sustainability, which is the crucial element of all these. No matter what you want to talk about, no matter what you think you need to do, without social sustainability, you just get into all kinds of infighting, without getting anything done. The third dimension, which was highlighted initially by Andrew Shun, he talked about the physical world of goods and services, and then the financial world of, which is, I don't know, I can't remember how many times he said, 10, 15 times of the value of all these things. And then he talked about the digital and data economy. Somehow he didn't talk about the derivatives markets anymore. We have jumped over the derivatives directly from financial services into digital and data. And I think we will also cover a bit of that. But of course, when we are talking about Asia's development, let's not forget that there are also very fundamental issues like infrastructure, like aging and all that. So with that kind of, we have a very wide spectrum of issues that we could talk about, but with limited time, first of all, I would ask our fellow panelists to speak for about 5 minutes, and then we will open up for discussions and questions and comments. Shall we stick with Sally at the far end first?
Sure, no problem. This is the danger of having a surname that sort of starts early in the alphabet. You get to go first. Fail fast. Okay, so so this whole session is about financing Asia's development going forward. We actually at the fund just released our outlook for the Asia Pacific region roughly a few weeks ago. So for those of you who follow our forecast, basically what we did was we forecast growth this year to be roughly about 5%, and that's actually a downward revision from our forecast in April. But going forward, we still expect Asia to be essentially the engine of growth for the global economy. In our baseline scenario, Asia still contributes to really full 2/3 of global growth going forward. So wherever Asia goes, the global economy goes. This is really the message that we want to impart in our forecast. But what's remarkable about our forecast over the past, I would say, few cycles are two things. One is that continuously we've downwardly revised our growth because of near-term uncertainties. This includes, essentially, as we know, trade uncertainties. But we also have highlighted some structural headwinds to Asia growth going forward as well. So what I want to talk about today, just use this opportunity to talk about one of the structural headwinds, but also end on a very optimistic note because, it's beautiful outside and certainly we could all use some optimism. So one of the headwinds we noted is this whole issue of demographics. Now, when you look at what we see in Asia, one thing that's really remarkable, that's absolutely striking, is that Asian economies are aging far faster than what we've seen historically. So you look at the working population in different Asian economies, they have already peaked in a number of economies, including Japan, China, Korea, Hong Kong, Thailand. That was surprising for me to see. And what was remarkable when we looked at the data is that if you look at this ratio called OH dependency ratio, for that ratio to go from 15 to 20, it took Europe 26 years. It took US 50 years, 50. It took Asia, on average, 15 years. So the worry we have is that Asia could really, as we say, grow old before it grows rich. And this is worrisome. So for a long time, we've been banking on, and I think Peter Wang talked about this during the lunch and keynote speech, that 2/3 of the global middle class will be here in Asia, and that this income convergence will be a powerful force driving growth here. But if you have a demographic headwind, what we're seeing are potentially two implications. One is that your overall productivity will fall because the number of people who are working will decline. And we have some estimates that we publish. Basically, on average, if you look at society, say China, Asian population will detract roughly 0.5 percentage point from growth over the next 3 decades. For Japan, it's a 1 percentage point headwind. So for a society, for an economy that's estimated to grow less than 1% this year, 0.5% next year, this is sizable. Same goes for Thailand, for example, or Vietnam. So this has implications. On financial markets, it has implications in terms of natural real interest rates. And again, we found this exercise that roughly on average, real interest rates would fall by anywhere from 1 to 2 percentage points due to aging. And this makes sense, as people get older, the way they save, the way they invest changes. So what does that mean then? When you have an environment where real interest rates are lower, global central banks are bumping into the lower zero bound, when productivities are falling, what does that mean for the future of growth, for the future of Asia? So what we did was we then turn around and say, well, what are some of the momentums that we are seeing globally and in Asia specifically? And one thing that we talked about, and Professor Spence talked about today, is this whole digital revolution. It's remarkable. When you think about the technological innovation that we're seeing today from, say, robotics, from computer technology, from AI, from big data, they are profound. They really have significant implications in terms of the way we work and live. So I'll end with a few statistics. One is Asia is already at the forefront of robotics. Not surprisingly, this is the manufacturing hub. So roughly 2/3 of the robots used globally are being used in Asia. But in addition to being a large consumer of robotics, we are also a major producer of robotics. Japan and Korea are the two largest producers of robotics. Japan has roughly half, 50% of the global market share. Korea has roughly 12%, sizable. So that's one. So in terms of aging population, robots are stepping in. The second point I want to raise is this internet commerce, digital payments, third-party payment technology that, again, Asia's at the forefront of. So one study we did, we looked into firms with online presence, these online commerce sites. So here I am worried about spending too much time shopping on the internet, but it turned out that what happened is that firms that have internet online presence, on average, can see a 30% boost to their productivity. And for an economy as a whole, these online presence boost overall export, all else equal, by roughly 50%. That's palpable. So economy-wise, again, on average, a 1% increase in digitalization boosts your overall GDP by 0.3%. So that is a sizable boost you can expect from digitalization. So recall earlier we talked about Japan, talked about China, they hit to growth from aging. Well, there is something that we can look forward to reverse that. So I'll stop there.
Thank you, Sally. Well, Sally mentioned about this digital commerce, e-commerce, and so on and so forth. Fred probably has a lot more interesting experiences to share on this particular front, particularly given the developments in China. Well, the floor is yours.
Thank you. Glad to be here. I just sticking to the theme of this panel, achieving finance and Asia's next stage of economic development, how to really close the funding gap. So I focus on that. I to make 3 points. But first, let me say, I kind of share Sally's, optimism about the medium long-term growth outlook here in Asia. For first of all, those last 75 years since World War II, Asia actually on the whole has been probably the single most successful region in terms of economic, starting with Japan, really rising from the ruin and the destruction of World War II, become an economic miracle. Then were soon followed by Korea, Taiwan, Hong Kong, Singapore, the so-called East Asian dragons. Then just we think maybe the era was over. Then the rise of China, even on a big scale, and even more successful, the transformation of China. So much of Asia, we have so many successful examples. I think that we can look into, we can borrow from, we can get inspired for the rest of the region. Number one, number two, we also inter-region integration is well underway. Inter-regional trade has been rising significantly. Even last few years, when the world trade as a whole has been stagnant, this independency, trade, openness, and I think will serve Asia well. And the third and the last is really Asian economies. Generally, I think I do to a varying degree all have very kind of risk-taking entrepreneurial culture. Southeast Asia, South Asia, as well East Asia. So now, economic theory and evidence say to grow you need investment. Whether it's infrastructure, power plants, roads, telecom networks, or human capital infrastructure, healthcare infrastructure. So there are a variety of institutions, even including IMF, World Bank, ADB, McKinsey, and even my own little think tank, all kind of estimates how much Asia needs, So obviously, depending on the assumption, sensitivity, there's a wide range of estimates, but it seems to be the consensus, estimate, is anywhere between $1 trillion to $2 trillion annually for Asia, the investment gap. Some are physical infrastructure, like transportation, power, but others like social infrastructure, right? So actually, during lunch, I asked Maria, a longtime friend and economist I respect, also successful government policymaker on Indonesia. Maria immediately said, infrastructure is by far is the biggest impediment. So I think Indonesia is not alone in much of Asia, even including China. China probably is the king of infrastructure investment, right, in the world. But even China, I see, there are some bottlenecks. So how to overcome this bottleneck? We need investment. So 1 to 2 trillion. That's not small pocket money. The opposite answer, is from domestic savings. And fortunately, Asia, again, with varying degree, generally have a fairly high savings rate. So, as a policy, just make sure the institutional arrangement, financial markets, tax system, some are like demographic and the structural factors. Make sure Asian economies continue to maintain fairly high savings rate, so as to fund the investment necessary to sustain economic growth. The problem, however, as China's experience shows, China when started in 1978 reform, actually China's savings rate was among the highest, very similar to the rest of East Asian, 35 to 38%, right? Not as high as the peak, 45%, but high enough, way above global average. But the problem is the financial system is such, much of the savings either in the under mattresses or sleeping in the state-owned bank deposits, not able to be channeled to fund most productive investments, to back the most talented entrepreneurs. So the answer is financial reform, right? You need to banking system or markets to make sure there's efficient intermediation, so particularly towards the private sector. I'm not, infrastructure, obviously the government plays a huge role in terms of externality, and some of the big scale infrastructure projects need the government from design, planning, design, coordination. But even there's a big role for private sector. I give you one example. When China opened up, Shenzhen, right? Shenzhen today is the world's undisputed workshop and exporter. But when China opened up, there was no infrastructure, no roads. Fortunately, there's a Hong Kong entrepreneur, Golden Wu, Princeton graduate, Hopewell Holdings, decided to build the first highway in mainland China. So it's the Shenzhen-Guangzhou Expressway. So because China even had the money, didn't have know-how and expertise to run the highway in these toll roads, right, the first time. So it's a BOT project. So Golden Wu, Hopewell, built it, financed it, built it, operated, and eventually transferred back to China. Very successful. Later on, today, China probably beats highways better than anyone else. But at the beginning, you start from scratch, right? So you really tap into private sector and and global capital. The second example I will give is in a different sector, because insurance, right, financial service. So I know a brilliant entrepreneur in China. Actually, I worked with him all his time, called Peter Ma. Someone of may know him. Actually, he's now the biggest shareholder in HSBC, created the world's most valuable insurance company from scratch. He used to be a driver. He was never an insurance guy. So he created Ping An in 1988 in Shenzhen. But he really didn't know, he had no clue how to run an insurance business. Fortunately, 2 years later, China opened up to invite the AIA. AIA was first, actually like HSBC was founded in Shanghai, but then become a foreign company. So went back to China, and Peter Ma rode a bicycle with his colleagues to follow the AIA agents. Look at them, how they sell insurance products. Because China comes from central planning. He has never seen like a company to knock on the door of consumers to sell products like insurance, right? Chinese state-owned companies like, you come to me, right? You know, there's never have the customer service and the selling and the marketing. So in this case, you know, AIA came to China. Yes, they invested in China, put capital, you know, create jobs, but the spillover effect is far greater than what the closing the local financing gap. It's really, you know, bring a whole business model, best practice, know-how into China. So the message for Chinese business, even for many Asian countries, you have high savings rate. So in theory, every project in the country, whether it's a power plant or expressway, you know, can be financed 100% domestically. It's still there's great virtue for it to open up to attract foreign investment, because FDI often beyond the dollar, they bring the spillover effect, you know, to enhance productivity and inspire entrepreneurship. So you're not speaking of FDI. I would just before I finish maybe one last 30 seconds is the One Belt One Road. You know, it's been since China launched this initiative. There's been much of the Western commentary is harshly critical. As a Chinese, I agree that China need to be very careful in terms of communication, transparency, environmental sustainability, you know, labor standards, and so on and so forth. But you know, we all know, you know, even within Asia, for example, Africa and Latin America, $2 trillion funding gap. Someone need to, you know, help, you know, and China definitely is now as the largest credit country, and as Chinese economy slow down, domestic opportunities start to not shrink, but you know, maybe expand as at a less pace than before. So many Chinese companies are thinking about going out, and Asia obviously is the first stop. So you know, I would encourage Asian countries to be open-minded, working with China, but also actually, you know, with Chinese government and lending agencies and enterprises, also working with the IMF, World Bank, ADB, in a global partnership. But I do think China can play a very, very important role in helping financing Asia's next wave of economic development. Speaking of infrastructure bottleneck, you know, I know a lot of German companies like Siemens, for example. I know the CEO Peter Losch, you know, for a long, long time. His engineer actually spent time in Hong Kong, Chinese University of Hong Kong as a student. You know, Germany used to be a model of engineering excellence, and Japan has opposite. But now even Germany, right, it took forever for them to build an airport in Berlin. China, the first, you know, new airport in Beijing is like that, right? So definitely China is very, very good. Not only has a lot of funding power, but also has the know-how to build modern, complex infrastructure projects, really based in class. So I do think, you know, Asian countries need to find a way to work with China, but also address some of the concerns, right? And to leverage China's role to help financing many of the critical infrastructure we need in this region. Thank you.
Thank you, Fred. I think you have highlighted a very important issue, you know, this so-called funding gap for a lot of infrastructure and other social and other, you know, education and so on, all kinds of investments in Asia, and also for the emerging market as a whole. But then it reminds me that every time I read the IMF Global Financial Stability Report, you know, in recent years, it always says globally, you know, the whole financial system, debt is increasing. As, you know, absolute terms, in percentage of GDP terms, the whole world is increasingly leveraged, and therefore financial stability could be an issue. Better be careful. So how are we going to resolve this gap? You know, this is a question we could discuss further later on if we want to. But it also highlights the fact that increasingly we can't just rely on bank loans, you know, simple traditional loans alone to finance whatever we want to do. So increasingly we have seen companies going to private equity, venture capital funds, you know, and mobilizing other capital market opportunities. So in this aspect, and also the other very important dimension is increasingly we don't want just to invest in infrastructure, we want green investments. So it's becoming a more complex issue, And in this particular aspect, perhaps Julia could share with us some of your thoughts.
Yeah, thanks, Casey. After 10 years of QE, nobody should be surprised that the corporates are more leveraged ever, because that's the intention of the quantitative easing. But I think there's a big difference here, because as you mentioned, it's much of that leverage has, whether it's are now taken, it's the financing is coming from the non-bank sector. So I think this is another thing in which globally at the IOSCO and at the FSB level, we are also watching. I mean, in a way, when the funding is provided by the non-bank sector, there is the systemic risk of banks getting to, and now banks are much more capitalized. That risk is a little bit less. But I guess I like to move to a subject which I think in the last part of Peter Wang's speech, he was mentioning a piece about sustainable finance, and Fred talked about the intermediation between the funding gap between savings and investments. I think out here in Asia, the emerging markets are actually doing a pretty good job in promoting and mobilizing capital into more sustainable projects. I say so because sitting on these global committees, I see the emerging markets actually attaching a more importance to it than some of the more, I mean, particularly one major jurisdiction. But nonetheless, progress is being done. In broad terms, sustainable finance means like mobilizing resources to be channeled to projects that are more sustainable to achieve the 2-degree reduction objective of the Paris Agreement. Now, clearly, public resources and public money will not be able to do it, and so private sector resources need to be mobilized in the form of bank loans, bonds, or PE funds. Now, why would private money be concerned about it? If you are a fund manager, I mean, I hear this all the time. Notwithstanding a lot of talk about green finance, they would say, my clients and my investors are more keen to get a return, maximize the return. And is there's a clear trade-off between return and investing in something more green, then our client would be would like to get the maximum return. And we also have listed companies that said our value is in maximizing the returns for our shareholders. And so to achieve the goals of these countries, then quick and cheap way of achieving that is to burn more coal and polluting the environment. Now, we've heard about the equitable development and social sustainability. I think this is no longer the case. The priorities and values of listed companies are changing and should be changing. And business have to take into account the community welfare, the social objectives, and clearly, increasingly, if they do so, pollute and burn to achieve growth and maximize return, will pose legal and other risk. So I think there is increasingly institutional investors, in particular pension funds and asset owners with a longer term investment horizon, would like to invest sustainably, not least because of the pressure for the millennials investors, but this is so far doing more good to the society. So if I invest with a view of reducing my carbon footprint, this is all about how much good I do to the environment or how much less damage that I do. I think the reason why I'm here on stage talking about a regulator get involved is not because I would like to regulate and see funds doing more good to society, because it's difficult to measure what is the social, what is more diversity, or it's hard to quantify. I think increasingly regulators and we, SFC and IOSCO, are concerned is what the environment is doing to the firm, to the listed companies. That is, I think Mark Carney said it very well in the physical risk of climate, where if you are insurance companies, then if you have a lot of coverage in areas of low coastal line and floods, then certainly there are more compensations for the damages of climate change with the sea level rises. And extreme weather events are, it happened before in Thailand, disrupting the supply chain and it had an impact on production capacity. And then we also have situation where government announced a objective of changing to an electric car by certain 2030, and the car companies' income would be impacted. So I think now there's this new emphasis, and herein lies the rationale why financial regulators would play a role. It's the environment, climate in specific, has an impact and pose a risk to a company, whether you're insurers or a car company. And it's difficult to quantify, but then it has it had an impact, a value on your share prices. And if there's a risk there, then there is a need for disclosure. And that's as a regulator of listed markets, then this is where we are going. That is, listed companies should actually disclose the risks that the financial markets, that the climate is having or environment is having on the company. And I think even the SEC has a requirement that if the risk is material, you need to disclose it. So they can actually live with using this approach to require the listed companies for more disclosure. Now, Peter earlier on also talked about there are, and I do, when we looked into the matter, we see that there are too many standards and too many disclosures, different reporting requirements, which made it hard for investors actually to compare or to have decision useful information. So I think globally, I'm not going to drag on for too long, but globally we're seeing, and it's very rare because when you walk into a green forum, a regulator is actually being welcomed because they said, we want you guys to come in and set some rules so that it's more comparable information. So this is clearly an area in which both bank regulators and ourselves are looking more closely, because to prevent, which is totally consistent with our mandate, to prevent greenwashing, to look for some alignment in those standards in order to make the products more comparable. But I guess just a short word about Hong Kong. I think we are, the government is going to a huge amount of green bonds, and green bonds being used in this part of the world as a way in which they raise funds to fund into a sustainable projects. But it is a lot more than bonds itself. If you regard it as a conduct requirement, if you regard it as a disclosure requirement, I think you can watch that space, and SFC will be doing a lot more.
Okay, unfortunately, we don't have enough time for Julia to say more. Actually, Hong Kong is also the capital market, the source of funds for a lot of projects in the region. So in terms of mobilizing funds and so on, but we must press on. So being the chairman of the Hong Kong Financial Services Council, what insights you could tell us about what should Hong Kong be doing to promote financing for development?
The honest short answer is not very much, meaning not very much in terms of insightful thoughts. The longer answer is actually Julia's words. Speaking as a regulator, her final words were, there will be more regulation. Watch this space. Now, which actually really caught me, because I think of everyone on stage, I'm the only non-economist. I'm a lawyer, and when a regulator says watch this space, there will be more regulation, that certainly wakes me up. Being the last person to speak and being the only non-economist to speak has two things, has two implications. The good one is a license to be short, so I will be short. The bad one is everything I plan on speaking has been said. So allow me to take a slightly different tact. I can't understand the world in big statistics. Lawyers don't work that way. I have to understand things sort of at a personal level. And one of my favorite personal stories is earlier this year, I moved home. I bought a new place. I needed a new mortgage. Ever since I came back to Hong Kong 20 years ago, I had always had my mortgage with an American bank. More aggressive, better terms. I came back from the US, there was to start off with a relationship with that bank. So this time I went back to the American bank, fully expecting that they would offer me the best mortgage deal. But like any good consumer would, I took that offer, I went to the biggest bank in Hong Kong, you can all guess which, and I said, well, what is your offer? Now, surprise, surprise, they gave me an offer far better than the American bank did. And like any consumer would, I took the better offer, I went back to the American bank, I asked, beat this deal. And my banker at the American bank took a couple of days, came back and said, Mr. Lee, we can't. And I said, what do you mean? You're American. Of course you're going to beat the deal. And I said, no, we studied, we can't. So I went back to the big bank and said, well, I'm going to sign your deal. And by the way, how come your offer was so much better than the American bank that I had long had my mortgage with? And he said, oh, Mr. Lee, it's very simple. When we put up your application for a mortgage, up for credit approval, we didn't put you in any category. We just put you up as Lawrence Lee. And we told the story, or we wrote the justification as, you're a barrister, by your own professional ethical rules, you are required to book every dollar you earned into the same account. That's a peculiar thing about being a barrister. My bar council rule requires that every dollar I earned be routed through the same bank account. And it has to be routed through directly, either by check or bank transfer from the solicitor firm who pays me. Which means my bank has perfect information about how much I earn, when I earn it, from whom I earn it, the distribution, etc., etc. Now that actually has knock-on effect, and my banker at this big bank tells me, because every dollar you earn goes into this account, we know exactly whether you make investments, what type of investments you make, because we can tell from your expense pattern. We know when your secretary got a raise. We use that as a proxy of whether you're doing well. We know when you employ the driver, because you added a name to auto-pay. And incidentally, since you also do a bit of savings for your kids, we know exactly when you had kids too. And I was sitting there thinking, oh my God. Well, two thoughts. The smaller thought is, I have no privacy. But well, like so many people around Asia, that's sort of long water under the bridge. I don't think I, as an individual, will have much choice in arresting my loss of privacy anyway. The other thought I had was I immediately went back to my banker and said, well, you know what, after I signed this offer, I advise you to change jobs. And my banker said, Mr. Lee, what do you mean? I just got you a really good deal. Why are you saying I should change jobs? Have I not served you well? And I said, no. The banker's name was Andy. Andy, you can do this for how many customers? Maybe 100 out of this branch. I don't bank upstairs. I don't belong to the private banking branch. Maybe 100 at this branch. There are fintech companies out there that does it day in, day out, without any human intervention, and they have far better data points than you do. Well, my banker didn't listen to me. He's still my banker. But with that story in mind, last week I attended a Hong Kong-France FinTech Day. And at the reception afterwards, I met up with a Frenchman who has settled in Hong Kong, he's actually an engineer by background, and he has started his own enterprise in Hong Kong. And I said politely, well, what do you do? And he described exactly what I've just described. He basically teaches computers to do what my banker has done. And I said, well, why do you need to teach a computer to do it? And he says, actually, because if you do it automatically, you have far more data points than what you have just described, income, so on and so forth. If you do it automatically, you have data points as to spending pattern. And this, let me segue to one of my favorite stories. I'm running out of time, so I'm not going to teach you how to do it. I strongly urge all of you, when you get home today, to go on the internet and search the following words. Assuming you have an iPhone, search iPhone location service. The information that will be returned from that simple web search is going to teach you how to go into your iPhone and open up a app or a function within the iPhone. I assume Android has the same function. That will reveal your exact whereabout for the last n number of years, collated to how long you stay at that location, how often do you go back, what day, what time of the day do you usually go, and this is where it gets really interesting. And when you are there, do you tend to take phone calls? As a proxy of, are you there for funny business? Assuming if you're there for funny business, you don't take phone calls. And this I haven't cracked yet, but I'm told that your iPhone can also collate that information to whether you have paid by Apple Pay. And if you pay by Apple Pay, then they, of course, can collate to what you paid for, if it's a restaurant, what you ate, so on and so forth. And this actually comes back to finance. Someone in the audience, to which I cannot thank enough, a couple of years ago bought me a Fitbit. Now, I don't know whether he meant it. The Fitbit actually came with certain software loaded that can be linked to insurance companies who will then use my Fitbit information to regulate my insurance coverage and premium and so forth. I ended up not using the Fitbit and hence the size. But I sit here and I wondered, why bother with Fitbit? People go running, people go jogging with their phones. They can't live without it. You can't part with your phones for more than 15 minutes these days. And all that information is already on your phone. So one day when Apple says, I'm not in Apple Pay, I'm in Apple Insurance, they have better inclusion and exclusion techniques than anyone can imagine. Now, this probably doesn't speak to what Fred had mentioned, which is infrastructure. I think the gap between fintech and infrastructure is still quite big, although I'm pretty sure engineers are working on that. But it certainly speaks to other topics that have been dear to other panelists and myself, aging, ESG. I have here some data supplied to me of the aging problem. And I was going to cite that Hong Kong currently have 18% of our population below 65. In 20 years, we'll have 32. So slightly short of double. That actually is not as bad as South Korea. South Korea has 14% below 65. And in 20 years, it's going to be close to 32%. And Taiwan has a similar story. Pretty much everyone in the region, other than Australia, is going to have that sort of accelerated aging. So I was going to echo what Sally has said, until I was sitting here thinking, all right, well, I got to come up with a new angle. Sally has said what I planned to speak far better than I could. And it suddenly occurred to me, when I was a kid, which I would like to say not so long ago, it's actually a while ago, I imagine my grandparents. At 65, I would be worrying about their health and how many more years I have of them with me. Both of my maternal grandparents, to whom I'm closer, pass away between 65 and 70. But now, you meet someone at 65, your question is, have you done your jogging today? Right? So what, actually these statistics no longer tell the story that we assume they tell. To look at the new world of financing and development in Asia, we actually do need to factor in all these new things. If we use traditional aging statistics, it doesn't take into account that at 65, people are having their third career. It doesn't take into the account that at 65, instead of switching to interest-bearing investment and sort of slowing down and in the old days, counting their years, they're thinking, I actually need to monetize my house because I want to start a new business. So I guess as the non-economist, it is within my license to do so, which is to end with a challenge. Are we actually looking at the way we finance Asia's next phase of growth the right way?
Yeah, thank you. Thank you for these very interesting thoughts. We could, well, there are so many issues we could take on, but my clock says we have less than 9 minutes, and we must finish on time. So we are now open to the audience. I know a number of you are ready to speak, but first of all, Armstrong, you have the first hand.
I can speak loudly.
Yeah,
Lawrence,
try to speak louder.
yeah, Lawrence, you are not lonely. I'm a lawyer as well. You see. So, but I formerly work for People's Bank of China and China Banking Regulatory Commission. I was seconded to IMF in 2012, so I can say I'm the former colleague of Sally. So my question is very simple. Do you think the recent situation of Hong Kong will influence or challenge the global financial center of it? Thank you.
Thank you. In the interest of time, I don't think whether you would agree or disagree. Shall we take a few questions or comments and then we collectively handle them all together, depending on what your interest is? The second comment, Peter.
Maybe it's fine. I'll just speak louder. Yeah, this is Peter Yan from. Thank you. Yeah. From Cyberport. I just want to take on what Lawrence just mentioned about the fintech, the implication to a lot of things that we are now sort of discussing and various speakers are sharing. I think definitely for aging, for ESG. Yeah. Thank you. Even for infrastructure, we have companies at Cyberport. Cyberport, in short, is you can say university of for entrepreneurs. Focus on innovation and technology. So we have a community of over 1,400 companies, and a major sector is fintech. And for infrastructure, over the region, whether it's Belt Road countries, cities, or whatever, I think there can be financial platforms, funding platforms, through the crowdfunding, platforms that we can also, do something like that. We have a company that actually provide such a crowdfunding platform for Myanmar. Yeah, to do social projects that may be also related to ESG and so on. But then what I think Lawrence mentioned just now is a very a vivid or a lively example of what fintech can do, and data actually can do, enabling fintech, enabling aging applications, smart living, and so on. So just to, I think, give some of my thoughts or sharings on this. And there are so many opportunities in Hong Kong that we can definitely, I think, overcome the current situation. Now, just to quote the figures, Hong Kong government in the past 3 years have invested or provided funding of over 100 billion in innovation and technology. So this is not a small sum that will take effect in the coming years, and there will be a lot of good opportunities for younger generation and addressing some of the points that the speakers say this morning about giving them hope, giving them development opportunities. Innovation and technology is definitely one of the areas that we can probably try to do that. Thank you.
Oh, I see many more hands. Well, let's take as much as we could. Leland, and then Wallace, and then Marie, and then the gentleman.
Hi, Casey. Thanks. Maybe to answer Lawrence's question, I kind of agree that in the future, I think financing has to change. Again, if you look at Hong Kong, unfortunately, our luncheon speaker and his bank and other banks have really most of the capital, outside of government, And if you look at Hong Kong's, for example, given what's going on, SMEs, because of the U.S.-China trade war, are still telling us, the Chamber and other places, they can't get financing. And if it wasn't for the HKMC SME guarantee a loan scheme, not sure how much would be filtered down. To Fred, where I know you're familiar with, particularly with your investments in Ant Financial, 12 years ago, I set up a financial guarantee company in Chongqing. This is before internet finance, and a small loan lending company. And then just, I think, a couple weeks ago, the Banking Regulatory Commission has says they're going to shut down all internet finance companies, or really trying to really control the shadow banking industry. So I'd be kind of, I also think that the banks in China hold all the capital deposits, but the challenge is that over the last 5 or 10 years, that with all the QE that's been mentioned, that capital, that funding hasn't been going to where it's badly needed, where it's infrastructure projects, or in the case of here in Hong Kong, really SMEs. So,
Yeah, thank you. Wallace?
Wallace, I was an Asia Global Fellow from last year. So a theme that was very prevalent in the morning sessions was the burning disparities between the rich and the poor in income and wealth. And I guess in the West, we've noticed the increasing sort of popularity of so-called social impact investing. Which is embraced by a lot of actors such as pension foundations, sovereign wealth funds, or even family offices. I wonder if any speakers on stage, maybe an investor, regulator, or service promoter, maybe we could share some of your thoughts on how Asian countries are embracing on this front in terms of social impact investing, if any.
Thank you. Marie?
Yeah, I'd like to thank the panel for very insightful comments. I had a question quite similar to what was just asked. And I think this session should have been titled Financing Sustainable Development, in line with the theme. And this is the big challenge in Asia and in countries like Indonesia. And how what we are doing in Indonesia is trying to, we are one of the so-called model countries for the new climate economy, where you want to see sustainability and development not as trade-offs. And I think you added actually risks, right? So we've actually been able to show that you can achieve both, and you can actually achieve higher growth if you actually build a sustainable infrastructure, for instance. So the argument is powerful, and then comes the financing gap, right? And it does have to come partly from a lot of it has to come from the private sector, not just from the government. And the government has actually been successful in having green sukuk bonds, and we have the first SDG 1 fund. I think it's $2.9 billion. Then comes the problem. There are not enough projects to be financed. Yeah? Even though our FSA has also come up with sustainable financing guidelines, as well as requiring all listed companies, all banks, have to have corporate sustainability report related to any one of the SDG goals. So we kind of have the framework, but then we're struggling with, okay, where are the projects, and how do you get the feasibility of these projects done? It turns out that you do need funding to get the projects structured in a way so that you can have the measurable impact and so on. And I think finance companies, pension funds, all those have a very important role to play in achieving this. You know, I think Hong Kong Shanghai Bank has actually stopped lending to coal-fired power plants, if I'm not mistaken, and more are doing this. You know, so but we need to have I think at the project level. More understanding how you actually structure them in those so-called blended finance kind of structures. So if any of you have any advice, we are in Indonesia, we are at the beginning of this, and I think we're looking for ideas. Thank you.
Thank you. The last question?
Thank you. George Aboni, I'm with the Session School of Management in Bangkok. Two quick questions on infrastructure and public-private partnership. One is, we continually talk about the need for institutional investors to be financing infrastructure. So my question would be, who are underrepresented globally and in the region, what would you see as the key factors to mobilize institutional investors to invest in projects? The second question is, Gordon Wu is a good example as a pioneer of public-private partnership, but the framework for PPP hasn't really changed a whole lot since the early 90s. We're looking at digital technology essentially fundamentally changing the way we do business. So the concept of PPP as a pyramid of contracts over a 30-year period is going to change. So I'd be interested in your thoughts on how the framework for PPP is going to be disrupted by digital technology.
Thank you. Unfortunately, we don't have a lot of time. Can I ask all the speakers to focus on the questions you want to address within 45 seconds?
I'll be quick. As a macroeconomist, I'll say this. Digital technology is disruptive in a way that it has forced us to rethink how we do things. So one example is loan allocation, credit allocation, and the whole issue of debt overhang. I think we've seen examples in China, but certainly elsewhere throughout Asia, and certainly here in Hong Kong with the introduction of virtual banking, how it really forced traditional banks to think hard about their business model and how to intermediate credit. And I think that disruptive force can really introduce quite a bit of efficiency improvement and certainly a new way of thinking about things.
Just echo the point. I think the two questions. One on how to ensure inclusive, growth, i.e., without the running away inequality that could tear society apart, but also, how to enable Asia to develop sustainably. So again, I would say, digital technology holds tremendous promise, as Chinese experience has shown, compared to previous technology breakthrough, where if you want to replicate, you still need to put a lot of upfront fixed cost. To, for example, steel technology, right? You want to build a steel mill, you need a lot of sunk capital, in the first place. Whereas digital technology, where it takes a lot to develop, but then the user, cost essentially is free. So it's very easy to allow mass adoption at zero cost, okay, and scale up. So that will enable latecomers like China or Indonesia to kind of close the gap very quickly, or even in some cases leapfrog. So that I think, for Asia's next phase, how to harness the digital technology, to aid economic development would be key. Now on so again, this is also actually make it more likely in terms of inclusive growth. Alibaba e-commerce, think of like e-commerce retailer company, and the financial fintech company. So they basically enable tens of millions of small businesses. It's really daddy mom shops, and also more than half of them on their Taobao platform and team partner is actually women. Okay, so everywhere in China and in the rest of Asia in the world, women are often I find it more difficult to access capital, so they're hampered by, so with the big data, with the mobile internet, and so the previous off limits, like traditional funds, underwriting cost is too high, too prohibitive. Now make it possible to underwrite loans to tens of millions of people at the favorable terms. Because of the data available, because of the risk management it affords. Therefore, so you can have a situation where you can have faster growth, but also more inclusive in terms of empowerment of traditionally fringe group like a woman, and job creation and poverty reduction. So again, I don't do obviously unqualified endorsement about the digital technology. I see its downside, but the overall for later comers, I do think how to really the education system, the infrastructure, obviously without the basic connectivity of functional cellular coverage. Internet broadband, you could not do this, So you need to have the basic infrastructure, but then you have the basic education system. People have the basic skills. Once they have a mobile phone in their pocket, they can do all these amazing things, whether it's commerce or fintech. So I do think that this is should be incorporated in the development blueprint of Asian countries going forward.
Since I'm the only one from the public sector, I will take up the first question on the social events. How is it affecting Hong Kong as a global financial center? In the last 4 or 5 months, we at the SFC as well as the HKMA with the bank regulators have worked non-stop to make sure that our markets are open non-stop. I must credit the financial institutions for being very resilient. This is a sector which is most stress tested in all times, whether it's the Asian crisis or the global crisis or Occupy Central. So we do have a way in which we cope with these, whether it's a market shock or it's a BCP, that is business continuity issue. So we ensure, and when we checked, and they are for business continuity, like what happened this morning. I'm sure in your office, maybe a third or even up to a half of your colleagues, maybe it's not able to come to the office on time, or even cannot come at all. We've expected disruptions like this, and all the financial institutions have reported that they have triggered either a remote access to the office so that trading will continue, and there is actually no, before it came out, we've already got assurances that all the brokers are able to plug in and trade. Most of the transactions are being done online, and so I think before noon there was reports of disruptions at the exchange center, and we all know that even if you surround that exchange trading venue, the operation will not stop because it's actually not there. It's in our data center. Now it doesn't. Over the weekends, I'll be very frank in this room. Over a number of weekends, we see bank branches being, the windows being broken and fire set on these bank branches. And a lot of the banks actually have maintenance people, repair people, worked nonstop to ensure that Tuesday or Monday when they open, it will still be open. And I asked them, well, it's a bank branch, it certainly would not disrupt the services. They were saying that, well, they have a lot of old ladies who come in and would like to withdraw $100, $200 for their dim sum in the morning. They want to make sure that their services will continue. So I'm really touched. Really touched that our financial sector has been very committed to ensure that the services continue. On the market side, we do stress testing, huge stress test assumptions, because this is what our business and this is what the firms expect. So it's not only for the events of Hong Kong. The markets globally has been and going through a very choppy time, and so we do ensure that in terms of banks, you know that their capital adequacy ratio is almost 19%, and their liquidity coverage is huge. For our brokers, we ensure that they don't overextend themselves. We tighten the margin financing rules. So all these preparations and all these stress testing are helping to make us still in business and still operating. And it's important whenever there's a rumor on social media, we refute it immediately through tweets, through social media, to ensure that confidence will stay. But confidence is the most important thing to hang this financial center together.
Thank you, Julia, for all these assurances. Lastly, Lawrence.
I will be shorter than 45. I'll be shorter than 45 seconds. Focusing on Leland's question, SMEs. Again, tech here can help. I'm sure it's not 100% the solution. The largest factoring firm in the UK, actually the top two, are both non-financial institutions. And they solve a very simple problem. If you sell to Marks & Sparks and you're holding the invoice to Marks & Sparks, it actually legally ranks higher than AAA because you rank ahead of Marks & Sparks bonds. It's a trade debt. So legally, you will be paid first. You will be paid on par with, actually not quite on par with the employees, but just behind the employees. You are the second best kind of credit there is out there. The problem is, if you take that invoice to a bank, Barclays, Lloyds, whatever, they can't quite handle it in a tailored way. So a fintech company came along and said, you know what, as long as I can tell, let's say it's Leland holding the Marks and Sparks invoice, that Leland is genuine, that Leland has a history of selling to Marks and Sparks. I'll use that as a proxy that this invoice to Marks and Sparks is real, and you will get a far better price factoring on that platform, not to a financial institution, but directly to funds, money market funds who are looking for 90-day return, so on and so forth. And within a matter of 2 or 3 years, they overtook all the banks in the factoring business in the UK. There's an Asian angle to this. A similar firm tried to come to Asia. The business model is sound, except they have one problem. Whereas in the UK, most of the data is within the same legal system, and it's relatively easy to gather. You go to a few points, you gather it, and they roughly enjoy the same sort of credibility. You can't do that with Asia. If Leland, you sell just across the border into Shenzhen, the same data now is split into 2 pieces, and half of which, and I don't want to say too many good things about the Hong Kong government, is at least relatively easy to get, and the other half is impossible to get. And even if you get it, you can't get it in a way that matched the 2. And that was the reason why the same business model in Asia took longer. And that's also the reason, one of the reasons why you see quite a lot of projects going around in Asia that has to do with KYC cross-border, not as big as, for example, in the US, because KYC is KYC in the US. You go to the same data points, you get it. And once we figured that out, I think that we will see quite a lot more activities around Asia.
Okay, thank you. Unfortunately, we don't have enough time to go through all these issues in detail, but I hope this very quick overview of some of the important issues will give you a lot more thought, areas for you to explore further. Could you put your hands together to thank our panelists again? Thank you very much. Thank you all for joining us.